I'm going to discuss with you the recessionary gap that is impending on the United States economy. Here we have a lovely graph that indicates the long-run aggregate supply and equilibrium at full employment. You have your short-run aggregate supply at its initial position and your aggregate demand at its initial position. I believe that the aggregate demand has shifted left and the short-run aggregate supply has also shifted left, increasing our price level and decreasing real GDP, causing the recessionary gap and a new equilibrium price here. Some key factors: unemployment insurance has increased, federal government transfer payments have increased, and personal consumption of goods and services have decreased, as well as the real GDP. This graph from Fred indicates the number of people receiving unemployment insurance benefits. It is greatly increased. On March 14th, there was 1.8 million recipients. By April 11th, nearly 16 million recipients. And this only indicates how many people actually were approved. This would cause SRS to shift left, an indicator of recession. With unemployment on the rise, we will see federal government transfer payments also on the rise, and has been continuing to rise throughout history. At the end of the fourth quarter, there has been a deficit increase, and the COVID-19 stimulus bill will only add to this deficit. The greater need for transfer payments is due to the impending recession. On this graph, we observe personal consumption expenditures on goods decreasing by negative 0.0331% in just the first quarter of 2020. This causes the AD curve to shift left, another indicator of recession. And with only essential businesses open, I predict quarter two will only continue to decrease the AD even more. On this graph, we see an even greater decrease in personal consumption expenditures, except this is on services, all the way down to almost negative 1% in just a few months. This would cause the AD curve to shift left, another indicator of recession, and due to social distancing and sheltering orders, I predict this will continue to drastically decrease in quarter two. And the greatest indicator of recession is right here. Real GDP percentage change at an annual rate has decreased by 17.36%. In quarter four, there was a 2% change, and by quarter one of this year, negative 15.26% change. AD and SARS shift left, major indicators of recession. I believe the COVID-19 pandemic has caused this aggregate demand to shift left. Consumption has decreased. Expectations are low, future income is low, net wealth is very low, household liabilities are greater than assets for many people at this time. Investment has decreased. Expected rates of return has decreased due to the stock market crashing. Government spending has increased because of transfer payments in the form of a $2 trillion stimulus. But net taxes are decreasing, our surplus is decreasing, real interest rates will go up, and so will our deficit, borrowing, and debt. Additionally, net exports decreased due to the worldwide shutdown of trade due to border restrictions and only essential businesses operating. The COVID-19 pandemic, I believe, is also causing the SRAS, short-run aggregate supply, to shift left. Unemployment is at an all-time high. Productivity is very low because of this. Cost of resources and price of inputs have increased, causing inflation, which is going to lead to a long-term stagflation. Imports are down, leading to a demand for domestic goods. And increased policies on social distancing and sheltering is decreasing prospective employees for searching for work. There's been an increase in supply shocks due to hoarding and layoffs. Essential businesses only are operating. You can see this when you go to the store and there's no toilet paper, masks, gloves, hand sanitizer, or disinfectant to be found. I believe that an expansionary fiscal policy in the form of stimulus payments for consumers and businesses will fix our economy. This will lead to a greater consumption on goods and services, greater investments, increased government spending. This will also increase expectations, future income, net wealth, and expected rate of returns. Aggregate demand will shift right back towards its normal equilibrium. Using the simple spending multiplier, if $100 billion is the initial increase in government spending and the MPC is 0.75, we'll see a $400 billion increase in real GDP. Imagine what this would do with a $2 trillion stimulus. Hopefully, aggregate demand will increase, shifting back right, close to the long-run aggregate supply. In conclusion, I believe that these stimulus payments is the best chance for the United States to fix the economy. Putting money back into the hands of consumers, putting money back into businesses will only help our economy continue to run. Without this stimulus, we might see the US dollar crash, we would see inflation, prices would rise, there'd be way more supply shocks, shortages, home closures, homelessness would increase. We need to make sure people have enough money to pay their mortgages. We cannot see any more people losing their homes like we did in the last recession.